Welcome to Satya Skills. In this video, let us learn how to revive the life policy. Life policies are valid only when the policyholder pays the premium regularly. The insurance company fixes installments to pay the insurance premium in a convenient way, maybe monthly, yearly, etc. Sometimes policyholder fails to pay the installment in time due to various reasons for a long time. The usual practice is that the company sends reminders to the policyholders about the payment of premium. If the delay exceeds a fixed time, policy loses its validity. Policyholder is given a facility to revive the validity of the policy by giving life to the invalid policy. The process is called revival of the policy. The Act provides information on the revival of the policy. It is in the following way. A policy lapses if the installment premium is due. That means they don't pay, including the grace days, usually 15 days in case of monthly payments, 1 month in case of other modes. Revival is novatio, that is the fresh contract, and hence the insurer can impose fresh terms and conditions at the time of revival of the policy. Generally, lapsed policies can be revived during the lifetime of the life assured, but before the maturity date. Policies can be revived within a period of 6 months from the due date of the first unpaid premium on payment of arrears of the premiums with interest. And then after 6 months from the due date to first unpaid premium, policies may be revived before maturity date under any of the following types of revivals. It requires certain eligibility conditions and a satisfactory evidence of health is to be produced, like ordinary revival or special revival, installment revival, loan cum revival, survival benefit payment cum revival. Ordinary revival. A policyholder has to comply with the following consideration of revival of a lapsed policy. Payment of arrears of premiums with interest in one lump sum or at one time. Then production of satisfactory evidence of health whenever is required. Revival on non-medical basis is another one. Under policy which comes up for revival in the event of new proposal being submitted by the insured, the corporation considers it under non-medical scheme. The revival of the policy should also be considered on the non-medical basis. For revival of a policy on non-medical basis, it should inter alia be seen that not only does the amount to be revived, that is the sum assured, less the paid up values, then not exceeding the prescribed limit, but also that no other policy or policies on the life of the assured issued on non-medical basis are in force for a total assurance exceeding the limit. That they look into that. Revival on the strength of medical reports submitted for the proposal or revival of another policy. The revival of policy may be considered on the strength of medical reports submitted in respect of new proposals or revival of other policy on the same life provided medical reports are in force. The medical examiners authorize the limit of is sufficient. Usually they say 6 months, 1 year, that limit they consider. Then underwriting rules. The rules prescribed for underwriting new proposal should be applied to revival and reinstate of policies. The revival should be on the existing terms only, even if the new proposal on the life could be underwritten more liberally. Where revival requires a higher rating than that of the original acceptance, such higher rating should be imposed on the basis of age of the assured on the date of underwriting, the amount to be revived on the date of lapse, the unexpired period of risk on the date of underwriting. After arriving at the actual extra premium per annum for the amount to be revived on the date of lapse, the extra so derived should be distributed over the whole of the original sum assured, and proportionate extra per thousand of original sum assured should be quoted on the policy holder. These are like calculations. Just I give one example. Suppose if original sum assured is 3000, sum to be revived is 2750, extra premium required will be 3% and total extra will be 8.25 per maybe the installment, and extra to be quoted is 2.75%. This extra premium is payable on all premiums commencing from the first unpaid premium. Special revival scheme. Revival under this scheme may be allowed if the following conditions are satisfied. The policy should not have acquired surrender values as on the date of lapse. Period of lapse should be from 6 months to 3 years. Policy should not have been revived under the scheme previously. Then it requires the following conditions. Application should be submitted by policyholder, satisfactory evidence of good health, then endorsement fee, in addition to difference in premium, minimum installment of revised premium, that is one additional amount, etc. Installment revival scheme. Policy should not be eligible for special revival. Period of lapse should be more than 1 year. There should be no loan on policy. Consent for agreeing to pay the balance amount required for revival and calculated interest over the remaining premium. Due dates along with usual installment of premium in the policy and date of revival and next 2 years of premium and the policy to be produced for placing endorsement. All these are essentials. So, that is all in this video. All the best.